Welcome to the Growth Zone. I am Christian Bartsch and I have a really interesting session for you today. We are going to be talking today about what makes a good startup growth strategy. What are the three things that business owners can do to maximize their business value? We're going to finish off with why it is so important to a business to have the right valuation based on a realistic foundation. Jennifer, please tell us about yourself.
Thank you. My name is Jennifer Peak, and I run a advisory group in the United States. We focus on the financial elements of mergers and acquisitions for small to mid-sized companies. And this company has been in business for about 10 years. Before that, I worked in corporate America doing similar types of work from an accounting and financial perspective on much larger deals. But I was able to bring that to the company that I started 10 years ago so that we could really provide that depth of analysis and that background to the smaller business owners that they may not have otherwise have access to. So we focus on business valuations, financial due diligence. We also help put together funding packages for folks that are either looking for growth capital or are looking to buy a business.
Great. So let's jump into our first question. And startups tend to have a different route, depends on what they decide to take. And they have, of course, many different options. They can focus on becoming profitable or on growing very quickly. Becoming profitable is good because it shows that a business model could last for a certain time. On the other hand, growing fast does cost a lot of energy and financial assets. So, what makes a good startup growth strategy?
Well, I almost always come down on the side of profitability, and you'll hear more from me on that, I'm sure, as we go through this podcast. But the elements of the growth strategy, I think certainly what you said is key. The profitability helps prove that you have not only a good business idea and a viable business model, but that you also have a good viable profit model. And a profit model can be part of a business model, but it doesn't necessarily mean that it's the same thing. So I'm sure we've all seen businesses that look like they're doing basically the same thing from a business model perspective, but their profit model works completely differently. And it can be the difference between actually staying in business and going out of business. There's certain elements of your profitability and your cash flow as a business owner that you have control over. And then there's some that you don't. And chasing the growth without having sort of that funding mechanism or that cash flow mechanism behind it can really put you in a position to have to make some very hard decisions. Most of the companies that I see that pursue a growth strategy are doing it at a very rapid pace with a clear exit strategy in mind or an investment strategy in mind. And unless you have that kind of a clear path and a fairly reliable view that you're going to be able to access additional funding down the road, that is much riskier than developing a profitable growth strategy from the outset.
Yeah, so Jennifer, you've been involved, as you said, in different acquisitions and divestitures for small companies and even big billion-dollar companies. What are the three things that business owners can do to maximize their business value?
So and in answering that question, I'm going to focus on, more of the small to mid-sized companies. First, we'll go back to what we were just talking about a little bit, and that is a consistent and sustainable profitability. One of the biggest factors in maximizing your business value is also one of the biggest factors in having somebody who's external to your company be able to purchase it. And that's that profitability. One of the key things that we see business owners do is they make decisions, especially in the United States, around minimizing their profit so they can minimize their taxes. And that certainly is viable. No one wants to pay more taxes than they have to, but in having a tax strategy that is rooted in having a lot of expenses so you don't have a lot of profit, you're minimizing your long-term value. One of the key elements of a valuation calculation is your bottom line. And the smaller that is, the smaller your valuation is going to be in general. There are certainly exceptions, but in general, that's going to be true. The other element to it is that when you're talking to somebody who is considering buying your business, one of two things is likely going to be true. They're either going to want to get a return on their investment, i.e., they're bringing their own money to the table, or they're going to need to get the transaction financed. And any sort of financial assistance, whether that comes from a traditional bank or it comes from a private lender, they're going to want to make sure that their loan can get paid. And the profitability of the company is what's going to help them assess that. So there's two different reasons that you really want to focus on that profitability. The second item is that there are a lot of business owners that serve a very key role in their company. And I'm not talking about being the CEO. I'm talking more about they're the primary salesperson, they're the face of the company or the brand of the company. Maybe they're the person in charge of production. So having replacements available or having a plan to put a replacement in that role is critical to the business value, simply because if that key person disappeared, then the value of the business is also mitigated. And then the third one really has to do with customers. And there's a couple of different ways that I look at customers. First and foremost, it's having recurring revenue, like some sort of a subscription, is fantastic. That definitely builds value. At the other end of the spectrum are sort of the walk-in retail stores where you may or may not have recurring customers, just kind of depends on what kind of service or product you have. And then there's a spectrum, right? There's recurring customers that aren't on a subscription, but continually come back to you for products or services or new projects, and versus the one-time buyers. The other element that we look at for customers is whether a company has a significant concentration in, say, their top 1 to 5 customers. So I know businesses love serving fewer customers and doing a really great job and, having, say, 5 customers. The challenge with that is that if any one of those customers leaves, that is a significant detriment to that company. They're going to lose 20%, 50% of their revenue almost immediately when that customer walks out the door. And of course, that has a lot of issues and presents a lot of problems with the value. And that's what, even if that customer has been around for 25 years, there's always the risk that something can happen with that customer that is completely outside of your company's control. So those are the top 3 things that I look at and that I feel like are the most within the control of the business owner.
Yeah, that's absolutely true, because so many companies then think that they really have a big business, and if they're only just really dependent, 50 or even 60 or 20% even of the revenue is just based on a very few big customers, and yeah, losing the customer can be very painful, or can even mean that, let's say that even it doesn't mean even that the company or the customer goes to a different company, but they just need to go bankrupt,
Right.
not pay the bills. Then you have a big problem. Whether it's $5,000 or $500,000 or $5 million that haven't been paid, it can be painful and can even kill the entire company. Or, for instance, in some countries, for instance, if the client goes bankrupt, then the insolvency managers that are put in place by the courts can even demand that you pay back the payments received 3 years back, which can kill some companies.
Absolutely.
It's absolutely crazy, and that's why one has to be properly diversified as well in one's client base. So, to my final question, and as we've heard, it seems that startups often have difficulty in getting a realistic number that really depicts a company's true value. That sometimes puts investors off as they do not take them serious enough. I think it's just a few kids from university don't know what they're doing and they're just having fun, and they don't want to maybe fund their excursion into the business world. So, why is it so important that business value has a realistic foundation?
Well, it's certainly part of what you touched on as you were leading into the question in terms of attracting investment, if that's one of your goals. But the other reason is that, at least in my experience, when I've looked at startups and even helped some of them formalize their business plans and figure out, is this really going to work? Do you have the right quote unquote math in place? Um, is that a business plan not only can help you do the things that we've talked about, but it should be the initial measuring stick by which you review your performance. And that can, when you have an existing business, you can look at past performance as an indication of what to expect. When you have a startup business, the only thing you've got really is your business plan. You can certainly look at other companies in the marketplace and see what their performance has been and use that as a yardstick, but you probably did that when you developed your business plan. So really keying in on that is important. I've seen way too many startups take their eyes off the ball and not pay attention to their business plan and then get caught in a lurch. That is particularly true if you have some sort of seasonality in the business. So as an example, I worked with a startup company a couple of years ago, and it was we were very definitive in their business plan that there was seasonality in their business, that when we hit certain months of the year, there were going to be indicators that, their revenue was starting to decline just because that was the nature of the business. And when that happened, they needed to scale back on their staff. They needed to scale back on their product ordering. And the business owner didn't have the systems in place to track any of those key metrics, which it's basically sales, and didn't realize that business had turned down and had too many people on his team, and he ultimately went out of business. I mean, it didn't happen overnight, but it happened in a very short time frame. And when he called me, he was in dire straits at that point. I'd helped him with his initial business plan, but then he had gone on his way. So when he calls me and he's in dire straits, and I'm like, okay, but Mr. Business Owner, we talked about this when we did your business plan. Were you monitoring it? And the answer was no. He got so caught up in his daily work. He got so involved in a lot of the really good press he was getting around his business because it was a little bit unique for our area. And he just wasn't paying attention to the business plan. So having a business plan and a related value that is built on a realistic foundation is what makes it more likely that your startup is actually going to make it through that first year or that first 3 years. And if you have a business plan that's throwing off some crazy valuation, when you haven't even sold any products or services, I think makes it much harder to determine whether you're being successful when you launch your business. It's also makes it less likely that as you actually do start selling things, you can bring any of those investors back to the table. A lot of educated, sophisticated investors will reject an offer and they will not revisit it. So you don't want to be unrealistic and sort of unicornish, if you will, in your projections and your valuation expectations, because those are people that you won't get back to the table.
Yes, that's absolutely true. So let me summarize what we just heard today. So as you said, you've been focusing on areas to provide a deep analysis, such as business valuation, funding packages, and all sorts of sizes of business from small to big companies you've been handling. And especially as well, all these strategic sides of keeping the business on track and being able to have as well the due diligence that you need, either for getting in investors or even exiting as well a business. And keeping in mind that if you want to exit, you need to be able as well to either replace yourself or replace the key people who are going to exit. And when we look at it, especially when we were talking about the growth strategy, it's so important that we have in mind that profitability is important. And at the same time, it is a proof that our business model should work. Nevertheless, it depends very much as well on the profit model so that it really is able to survive in the long run as we continue to try to grow, get greater market share or more depth or more a better foothold into the key clients that we're trying to get. And at the same time, it takes us really to the key thing of thinking, okay, how can we really create a consistent and sustainable profitability for our business in our niche or in our sector, wherever we are currently doing our kind of business venture. And it is important that even if we decide to sell, we have to be able to hand it over to an external person. They need to see, okay, can I take that business over and continue to run it? Or if I can't at the moment run it in a way that the people who started the business, that they stay there, that they continue at least for a certain time until the handover is properly done. And when I just see in my notes as well, you mentioned as well minimizing profits. Minimizing profits, of course, is great if you want to minimize tax, but it'll hurt you over long term if the investors think, well, maybe there isn't so much profitability, so the business isn't that valuable. You might have a good tax advice where you cut your costs and cut your tax, but in the long run, if you want to really sell the business, you have to have value. And that takes us as well to the idea of focusing what's really important for the business. How can we really grow it? And that's as well a thing about how sustainable our revenue is, particularly if we look at the kind of streams that the business has, whether it's a subscription-based model, or that's customers who, even if they are not on a subscription, they buy every model. Just look at some big companies who started very small originally, like Apple and so on, and they all run buy the next iPhone. They don't always run in the same amount of people, but they eventually, in most cases, actually stick to one brand and endorse it. Nevertheless, when we look at it, if we do have too much of a concentration in our top 5 to 20 clients, if we lose one of the clients, whether because he doesn't like what we're supplying or he decides to get another supplier or he even goes bankrupt and doesn't pay our invoices, it's a risk, and investors and even ourselves, we should be available and thinking about it as well, whether it's a significant risk for the business. If we invest in this business and we lose that client, is the whole business just going to collapse? Can we somehow replace that big account? Or is it just the first big account that's helping us to go and get more big brands? That's a key important thing. And when we look at it, as you said, the business plan, of course, helps us to stay on track. We have to pay attention to what we originally wrote in it, especially if we are at the beginning already aware that certain factors are going to influence our business, like seasonality and that. We really need to have systems in place that we can really track. We see how much are we spending, how much are we getting in, what's the profit margin every month, and see, okay, certain seasons where we expect certain reactions that we already see an indication that, for instance, the season is kicking in where maybe people are buying less of our products, that we're able to adjust the amount of staff we've got. Maybe we adjust the stock, or even when we know the season is going to kick in again, where we're going to sell more, that we have the stock that we need. Because if we have enough buyers and we haven't got enough stock, we can't use the opportunity of expanding. Well, it was great having you here on the show, Jennifer. And I hope to see you sometime soon again on one of our next shows.
Definitely. I appreciate it very much.
Thank you. I hope you found the information helpful, and I have for you quite some interesting topics in the next few episodes. Also, some guests from different countries, from the US, from Europe, from South Africa, people from Scandinavia and different regions. All business owners, investors, advisors, consultants, different kind of people in different regions. So the next episode will be focusing on the key topic of payment gateways. So where do we need payment gateways? We need them, for instance, if we've got an online shop, if we have funnels, if we accept payments from different countries, even if we are in B2B area, we can use payment gateways as well to accept payments. There are plenty of opportunities, and it doesn't just mean that it is only viable for businesses that accept payment by credit card. You can use it for debit card, bank transfers, all sorts of different systems, always very much depending on your location, on the location of your clients, what kind of business clients there are, and all these things. I'll be going deeper into that, how to use it as well, especially for your websites, for your promotions, and as well in using it as well for SaaS platform solutions, which means integrating payment gateways as well in business solutions. That's so important in today's world. The evolution of online business or e-business has really scaled, as now it's not only just something available to e-commerce related activities, it's also towards e-business. And that's a great opportunity for business all around the world. And what's even greater, even multinational businesses, and I mean not only the big corporates, as well as small businesses that have maybe very small subsidiaries that might be comprised of maybe just 2, 3, 4 people somewhere in another country, and have different bank accounts in different countries. You can combine that all together with one payment gateway. You can have even one main website, whether you then, depending on your client, depending on the country, the currencies used, you can even stream the payments around the different places and integrate it as well with different kind of accounting systems. But I'll be going deeper in that in the next edition. Just make sure to tune up and subscribe to our channel. Then you hopefully won't miss that episode. Well, that's all for today's episode of The Growth Zone. Thank you for listening. Make sure you subscribe to the podcast on iTunes or Spotify so you never miss an episode. Plus, if you haven't got your signed copy of the marketing book, stop by on our website at book.prmediareach.com and hurry, because the reserved batch of signed books are almost sold out. So the address is book.prmediareach.com. I'll repeat, book.prmediareach.com.